Howdy, everyone, and welcome to the Simplify Your Financial Life show and podcast. I'm your host, Adam Lawrence, and I'm joined by a special guest today, our very own Mike Minter. Welcome, Mike.
Thanks for having me, Adam. I appreciate it, man. And thank you for getting this podcast off the ground for us. I look forward to many more episodes to come.
Of course. Thanks for being here. I thought for our first episode, we could do something special and take an inside look into your role here at Financial Synergies. How does that sound?
Sounds good to me. Yeah, you bet. So obviously the Chief Investment Officer is my title. So I can kind of start with how I got here. That's kind of a little bit of an interesting track. I was not going down this road in college. I was going down a different track. I at one point had aspirations to be a physical therapist, and so I was taking the science, very science heavy, and going down that road in school. But I also had a business minor, and so I found myself kind of drifting towards the business-oriented classes and finance and investing. And that, to be honest, that kind of started my interest in investing anyway. Started with in high school when my parents opened up a mutual fund account for me. They opened up I think it was a Vanguard mutual fund account, and I remember talking to my parents about that, and they were very big on saving and investing, which is great. Taught me a lot. But I remember just being so enthralled and watching that account grow and compound over time, and just the beauty of investing and getting started early. So I really was interested in that from a fairly early age, and I think that passion just kind of carried over into my college years. And started to kind of overtake my interest in becoming, at some point, overtook my interest in becoming a physical therapist. Although I was a personal trainer in college, and I was definitely going down that road. I ended up with a Bachelor of Science degree. But by the time I got out, my passions had really kind of gone in another direction. And the thought of now going to additional years to become a physical therapist was less appealing. So I kind of I switched gears a little bit, and I had an opportunity to go work for a company in Houston after graduation. I went to Texas State, which is now Southwest Texas, but had an opportunity to go work for a company called AIM Investments. For anyone who was around back then, you probably remember AIM Investments. It's now Invesco. It was kind of a conglomerate, and Invesco essentially swallowed it up after the tech crash. I started in '99, just in time for the big tech crash. So I think I had one good year, but it kind of went downhill from there. And it was a great company. Don't get me wrong. I was there for a few years, but it definitely was a little rocky. But it taught me a lot about investing in the mutual fund side of the business, the operations, and I got to work with advisors who were on the other side of it, who were there working for their clients, right? And I'm working for the fund company, the product side. And I realized I as much as I had a career there in the future, no doubt about it. I mean, there's no question I could have retired there, but it was a massive company, thousands of employees, and I really didn't see myself at a massive firm like that for a long time. I always thought I'm either going to do something different and go to the other side, the advisory side, or I'm going to own my own business doing something else. I didn't really even know at that point, but I loved investing. So I was fortunate enough to, and Mike Booker just happened to be looking for someone at the time. This was back in 2003, and he took me on based on my experience, I think, with AIM at the time as kind of director of operations back in 2003. And it's been a hell of a ride. I mean, I thank Mike so much for giving me that opportunity, and he really gave me my shot, on this side of the business. And of course, Mike started the business 35 years ago, and still involved to this day. So I can't thank him enough for putting me on this track. And then he let me really kind of blossom within the firm. I mean, I wasn't just pigeonholed to operations. I was able to take kind of a turn to the investing side of it when the time came. And we've just got a wonderful team around us. So we were able to hire, Marie Villard, and of course, she's our director of operations, wearing a lot of hats. But that allowed me to kind of step into more of the portfolio manager role over time. And now I'm just blessed to have two phenomenal portfolio managers under me. Grant Ball and Tim Garcia Prats are just phenomenal. They are the rocks that kind of let me do what I do on a daily basis, which is kind of oversee the firm's investment strategy, the overall allocation, and kind of really direct the firm level communications around the investment strategy and what we're doing with clients. And I would never be able to do any of that if it weren't for those guys. So my hat's off to them. But so, and that's kind of my road here. I'm sure everybody's is unique in their own way. I mean, I just, to me, I didn't go down the path of finance initially, or certainly not financial planning or anything like that. But man, once I got into this, I just developed a real passion for it. I don't remember how many years into my career, but I decided to go down the route of getting the CFP, and that really kind of catapulted my knowledge and career a bit, and just really kind of engulfed me in the financial planning world, and it's been a hell of a ride, like I said.
That's awesome. So it sounds like it was kind of an unconventional path, but certainly one that led you to where you are today. So that's awesome.
Yeah, no doubt. I wouldn't change anything, but yeah, it took some twists and turns, that's for sure.
Very cool. That's awesome. Well, next, could you talk a little bit about some of the top things you're having conversations with clients about these days?
Yeah, this environment, they're all unique in their own way, and they all present their own challenges. And sometimes you're flying high and you got years of just boom, 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 everything's going up, and it just nothing ever seems to bring it down. And those are great. They're a fun ride, but you always know that there is the potential for a downturn, or either an economic downturn or market downturn. And this environment we're in now is unlike any in my career, certainly, with rising rates and this inflationary environment that frankly I have not seen in my investing career. We just really haven't had much inflation. I mean, inflation is there; it's always a variable, but it's never really been meaningful until now. And we've come out of this 40-year plus declining rate environment, where we just kind of got used to easy money monetary policy, rates at essentially zero. I mean, even negative in some cases, which has been how a lot of us in this business have kind of grown up with that, And so, financing is a breeze, and, free money and all that stuff. In those days, they're kind of over now. All you have to do is look at mortgage rates or go buy a car. You're not, good luck getting 0% finance. You can still find it maybe, but so these things have changed. It's all changed dramatically within the course of 18 months, 2 years. So that tends to be top of mind for most people. My gosh, what about these rates? What about inflation? And is this ever going to stop? And of course, the answer is everything ebbs and flows all the time. Will inflation continue to go up and never stop? No, of course not. Inflation at some point will be tamed and start to come back down to normal. The Fed is going to do what they have to do to get us there. Love them or hate them. It's probably the worst job in the world, being a member of the Fed, or Jerome. I wouldn't wish Jerome Powell's job on anybody. You can't please anybody, but I do think they've done a pretty decent job. All in all, could be a lot worse, So I do think they'll get it under control, and I think it's critical that they do. And then rates. I mean, rates are clearly, and they're intertwined. Inflation and rates. You can't split the two apart. So the Fed's indicated that they are going to kind of take their foot off the gas a bit in terms of raising rates. Whether or not they have one more this year, who knows? It's possible. And then into next year, I think they're being cautious in how they message this because they don't want to send anybody into a tizzy. But I think they're probably, we're looking at least a leveling off, maybe just a pause, if you will, and possibly starting to reduce rates at some point in 24. That's a possibility. I don't know, but and there are so many conditions that have to maintain for that to happen. But things can turn on a dime, and if they do, then I'm sure that they will reverse course if needed. But I do think those are this, no question about it, that has been the driving factor and the main point of communication for basically the last 18 months to 2 years has been that story. The economy is still kicking along relatively well. So we get a lot of questions around not only inflation and interest rate, but recession, right? The big R word. Are we going to enter a recession? And there's another one. I wish I could say yay or nay, but I don't know. Nobody does, which is a common theme with me. It's like trying to predict the weather, and 3 months from now on Tuesday it's going to rain. Nobody knows that, and people can prognosticate and make these predictions, and it's good for CNBC and all that. That's great, but there's nobody holds their feet to the fire if they don't come true. So we just don't do that. But I do think that it would be rare and unlikely to just all of a sudden enter into a recession still with very, very low unemployment rates and a job market that has slowed but is not anywhere near fallen off a cliff. So it's really hard to have a recession when you have such a strong job market. It's really kind of unprecedented. So could we go into a recession? Sure, but I think it would take a lot more right now for us to enter into a recession, and that would require some pretty hefty rising of rates from here to kind of slam us into a recession, which I hope they don't do, and I hope doesn't happen. But so I kind of see there's a possibility that we get out of this with a relatively soft landing. Again, don't quote me because I have no idea, but my gut feeling right now is that we might actually get out of this without a catastrophic, economic downturn or recession. But so those are the things that continually come up. It tends to be focused on inflation rates and recession. Yeah.
Yeah, that makes a lot of sense. That's been something that's, been top of mind for not just clients, but for advisors as well. We see it all over the news, and we read it online in articles pretty much every day. Can you talk a little bit about, depending on the scenario that we get one way or another, what clients should be doing or how they should be thinking about all these headlines they're seeing in terms of their portfolios and how that aligns with our investment philosophy?
Yeah, I think number one is diversification is always key. I think, you don't want to make knee-jerk reactions to the headlines, because that is first and foremost, because every day there's a doom and gloom story about this, that, or the other that, could potentially negatively impact your portfolio. No question about it. Whether those materialize or not, who knows? But it's like I always say, the news media, the financial news media, is not in the business of education and great information. It's information, but the wrapper is panic and fear and hair on fire. That's what drives ratings, and so they can't sit there on TV every day and say you everything's fine and don't do anything. They don't get paid to do that. So I get it, but that's what they get. They get paid to entertain, and they'll tell you we're entertainers. So I would say number one is don't put too much stock in headlines or what the daily commentators are saying about anything really in terms of the markets going down in flames or this. We have a couple of bad days in the market and all of a sudden everybody should sell every stock they own. That's crazy, number one, because just because you have a couple of bad days in the market, it might turn on a dime and never look back and have the greatest run, in 10 years. And they're not talking about real life, right? We have stocks, and a lot of these stocks might have massive embedded gains, and you're going to sell all your stocks and pay taxes on all those just on a whim. I mean, so these things they're not to be taken seriously. They're not indicative of your life. They're just comments, and they're just, hey, you need to get out of stock, stuff like that. So number one is, I would say, don't react to headlines or daily commentary on anything like that. In terms of overall portfolio allocation, that is always going to be driven by your personal circumstance and your tolerance for risk and your financial goals. So what we try to do on the front end is just get the allocation right at the outset, and then it will evolve with you over time. Of course, if you need to take on more risk or reduce risk, or have income needs that need to be achieved within the portfolio that we can help to transition over time, that's what we do. Any portfolio level changes, meaning funds or allocation changes that we feel are appropriate, we are constantly meeting about that with the investment committee on a monthly basis, and frankly, we're in contact every single day. We're talking about investment related issues and portfolio management. So there's not a day that goes by that we're not looking at this. But the reality is, it's very rare that you just say, you wake up and say, man, based on all these factors, we've got to make a serious change here. That's rare because we don't let current market factors necessarily just drive the long-term strategy of the portfolio. You can get into a real hairy situation trying to do that, because then you're talking about short-term factors affecting your long-term game plan, and it's a game that we really don't want to play. So we just simply don't do that. What is interesting about this environment, unlike any other, though, is you do have areas where you can make just incremental improvements. And one of the things we've been talking to clients a lot about is just cash in general. If you've got cash, for example, if you have cash just sitting in a traditional bank savings account right now, depending on the bank, I don't know, they vary, but I mean, you could be earning a pittance compared to what you could earn in an online savings account that's still FDIC insured, still backed by a major bank, and has zero risk really of anything happening to that cash. And it's kind of this free money situation that's just on the table, and all you have to do is grab it. And that's we haven't had that in a long time. So for instance, let's say you're earning 60 basis points on your cash in a bank checking or bank savings account somewhere. You could earn over 5% on that cash just by funneling it to an FDIC insured online savings or a money market fund. We're very aggressive about funneling all the cash, idle cash that we can for our clients into these higher yielding money market funds that are completely protected. They're custodied at either Charles Schwab or Fidelity. And these things are earning upwards of 5.3, 5.4% right now. So, or in that range. So those are just easy moves that we now can take advantage of, that we have not been able, that just wasn't even an option for, the past 20 years, essentially. So just easy moves you can think about, things like that. Other than that, if we're managing your account, trust me when I say we are constantly looking at this, trying to balance what makes sense for the long term with what's happening in the short term. And we do make moves. It's not that we don't ever make fund level moves or allocation changes. We do that. But right now we are looking at a few things. I don't want to go into too much detail, but we are looking at a few things, particularly on the fixed income side, and we're continuing to talk about that, and obviously would communicate that out if anything's going to happen. But yeah, it's an environment that keeps you on your toes for sure. Yeah.
That's awesome. That makes a lot of sense. With the very complex interest rate and inflation environment that we're in, I kind of want to circle back to our conversation regarding cash and how cash is yielding a lot more, and especially in those money market accounts that you mentioned. So how would you respond to folks that would say, hey, maybe I should allocate more of my fixed income side of the portfolio to these money market funds? Or, is it important to stay balanced based on the original allocation that you developed whenever, we, started working with you, and whenever we kind of nailed down your risk tolerance?
Sure. So yeah, it would be, it's absolutely reasonable and rational. And I get it. I get the thought process of, hey, maybe we shouldn't have this money in bonds. Maybe we just put it in cash. It's earning this great yield. There, that that is true in a little short span in this like microcosm of the world we live in right now. And I don't mean every fixed income fund. That's not true across the board, but it could be true. And you've got money markets or whatever earning 5%, which again we allocate as aggressively as possible. But you don't want to go overboard there. And yes, if you've got idle cash and it needs to be cash. I mean, you need that cash in the next 2 years. You really don't need to be investing in anything too variable. You need to have that in cash. Or something that even if you lock it up in a CD or a bond, you want to make sure that matures within you want to match that maturity to your liability. Or you could be in real trouble because there's going to be price movement there. Money market fund is going to be there when you need it. You're not there is dollar for dollar. You're going to earn your stated rate, and you get that cash when you need it. So that's where I'd have that cash. But definitely want to be aggressive with how you allocate it, because you don't want to just sitting in a bank account earning nothing when it's just you have the option to do that. On the other side, taking just Xing bonds and going with cash, I get the argument, but again, it's a short-term phenomenon that will not always be the case. That period, and this ebbs and flows throughout history. Everything up, down. There are going to be environments where you may say, "Man, why do we have any money in stocks? Bonds are earning more in stocks. Why don't we just sell our stocks and throw it into bonds?" I get it. I get that argument too. When you're seeing your stocks go down and your bonds are going up, I get it. But that's not the time to do that. We would argue that's actually the time, once you've had a nice run up in fixed income or, what have you, that you want to trim off some of those fixed income, buy into the stocks that are depressed. Because one thing I know for sure is that over the next 30, 40 years, stocks are going to outperform bonds. And if they don't, then you can quote me on that. But I would put probably most of my money on stocks ahead of bonds. That's why we take risk. You're compensated for that risk. It's the same thing with bonds. It's just we're in a weird environment right now. Rates are going up, bond prices are going down. And so these shorter instruments like cash and that, they're being dramatically affected by the shorter end of the curve. And those rates are going up, and they're benefiting tremendously from that. So it's a great environment for sure. And by the way, we have our fixed income portfolio is not just intermediate term bonds and long-term bonds or anything like that. We have very short-term bonds that are going to benefit from this short rate environment, this increasing rate environment, and they are. But we also have some more strategic fixed income and some longer duration. And yes, those bond prices have taken a hit. And it's not a particularly fun place to be necessarily right now, but that will turn. And what will, at some point, these managers remember, these are thousands of bonds within these funds, not just, one bond or, a handful of bonds. So there are bonds constantly maturing and turning over within these funds. And the managers are then able to take those proceeds and buy into the higher yielding new issue bonds, which is happening all the time. And so they're also able to buy these at a discount. And so they're finding tremendous value right now in the fixed income world. And it's going to take time for that to play out, but it will. And so what will happen is you'll have this fantastic portfolio of really great bonds that you picked up at a discount, and they're earning a better yield. So the overall yield of the bond fund is now better. And then when rates do start to tick down, that's really when you start to see that price appreciation on the bonds. There's an inverse relationship. So as the rates start to come down, those prices are going to go back up. And so now you've got a portfolio of better yielding bonds, and they're benefiting from the price appreciation as rates come down. And I'm not predicting rates are coming down next year, but they might. And at some point, I know they will. And so you will see that price appreciation. And yes, you'll still have, so what will happen to cash at that point? So cash, the rate on savings accounts and money market accounts is variable. So that those rates will come down and the bond prices will start to go up. And then you've also locked in those higher rates on those bonds that you were purchasing. And so then at some point, you're going to have the opposite reaction, which is, man, my bonds they're really doing well. And this cash I've got is now not looking so great. I understand that's not the case right now, but it will be. And so these themes take time to play out. But it's the reason that we don't make short-term moves and say, look, I want to based on where we're at now, let's just dump all this and go into cash, because we don't know when the tide's going to turn on that. But what we do know is a well-balanced portfolio of stocks and bonds and cash. It makes the most sense long-term. Yeah.
Yeah, that makes a lot of sense to me as well. And, what I'm hearing is that you want to always look at what is, the purpose of this particular item in my portfolio or the portfolio overall. So the purpose of cash is to be cash, right? It's not to be a fixed income type investment. And so you want to make sure that if you're, allocating money to cash, that you're doing so for the right reasons, right? Because, I think this is another huge part of it all is, on my side, the advisory side, whenever we, start working with you, we want to develop an asset allocation that's appropriate for your risk tolerance, not just now, but hopefully in perpetuity, until further notice, because, that's the way that we can get around, not having to make tactical calls, not having to, change a certain part of the portfolio whenever the market takes a dip or whenever it's up or vice versa. We want to choose an asset allocation that's appropriate for you, no matter the storm that's out there, or if the sun is shining. So I think that's how I think about it on my end. Is that how you would think about it as well?
Yeah, just well said. I couldn't have said it any better. I think we're trying to create durable, flexible portfolios that kind of that have the ability to evolve with you over time as your life changes, as your goals change. But it's not designed to then just turn corners every single time the market has a short-term change in direction, because that's going to happen all the time. We don't want to get into those short-term gains, because the honest truth is, over the long term, it does more harm than good. And we simply don't want to play that game.
Yeah, absolutely. And I think this really speaks to, the very name of our company. It's Financial Synergies Wealth Advisors. So, we take a total wealth management approach. We want the investments and the financial planning aspect to go hand in hand. And that's why we kind of always like to say that we want to be the quarterback and get our hands around everything whenever we start working with a new client. And so that I think is a really important point. But also, Mike, the way I think about it, whenever we're in the financial planning room and, we're going through the fact finding process and, we're learning about the client's details, we want to make sure that the investment tail is not wagging the desire to increase wealth, right? That's a way to grow your wealth, at a steady pace over time, but not necessarily to try to, hit home runs. We're trying to hit base hits, singles and doubles, and trying to, grow your money at a reasonable rate of return. But I think, where half of the value, a lot of the value of what we do is where it comes in is the financial planning side, because that's where we can say, okay, let's save more for retirement. Let's, open a 529 plan for your kids so that we can save for your kids' college expenses. Let's do Roth conversions every year so that we can maximize the tax-free growth of those dollars and reduce RMDs. And I think by taking that approach and bringing the financial planning into it, you don't have to hit home runs on the investment side, right? You don't have to try to, reach for the stars whenever you're really just trying to get singles and doubles.
Yeah, well said. I think, for us, it's always been planning, the financial plan, it becomes the blueprint, the foundation of everything else. It's really hard to develop a great investment plan without any idea of your financial goals and have an overall financial plan behind it. It's really hard. I mean, yes, you could say, oh, I want a portfolio and I want you to try to be as aggressive as possible. And that's fine. We can do that, but it's so much healthier to have a real financial plan with all those variables baked in behind it before we start investing money, because that's like kind of a ship without a rudder. You're kind of flying blind at that point. You need to have a good foundation behind why you're doing something and what you're doing and when. And the only, in my mind anyway, the best way to achieve that is to have a solid financial plan behind it. So we really do try to take that holistic approach with everything we do. So we're in close contact with, as you know, we're in constant contact with the advisory team. We collaborative on everything, and they come to us and say, hey guys, here's the plan and here's the investment strategy we want to create behind it. And then we go to work, we collaborate and we get that done. It has to be the driver behind everything we do. Otherwise, the investment side of it just doesn't work. So you said it exactly right, 100%.
Absolutely. Well, Mike, thank you so much for coming on the show. I really appreciate your time today, and we look forward to seeing your blogs in the next few weeks.
Absolutely. Thanks for having me, Adam. I really appreciate it. I think this has been great, and I look forward to many more episodes to come. Fantastic. Great job.
Thanks so much, Mike. Take care.
You too.
Thanks. Bye-bye.